Good day, everyone. Thank you, David and Anka, for um, inviting me to host my presentation here. My name is Gil Ben-Hur. I'm from the5ers.com. We are funding traders and growth program for Forex traders. And we will talk about order flow, and some of you might be familiar in its other name, which is supply and demand. I like to call it order flow because it's more about the orders that are placed in the market that we wish to trade. Um, Order flow for me is a very high accuracy trading. This is the name of the presentation, and I promise you that once you understand some of the concepts of order flow or supply demand, you would want to dive deeper and learn this material. So let's start. Just 1 second. Okay, 1 sec. All right. So what we're going to talk about today, first is what causes the market to move? And the answer laid out in the order flow. I will show you and give you the essence logic of why price is moving and turning, why it's respecting levels, why it is disrespecting some other levels. We will learn the key concept of how we can predict the market more effectively. And I must stress here that trying to predict the market is not the right way to go when you want to be trading, because you want to be bias free once you're in a trade. You don't want to reason and justify and have a bias while you're in a trade. You want to always be objective when you analyze and reassess while you're in a trade. So we're not trying to predict the market, but we do need to have a good idea of what we are wanting to do in the market. So order flow, supply demand is a very good tool to help us predict what the market might do in high probability. The other thing that we're going to talk about is how to realistically choose a good trade, how we can define a trade ahead of time before we get the signal. We can see it way time ahead, and we have all the clues that are going to give us enough time to enter or to plan a trade with a lot of time ahead. With supply and demand method, you can enhance your winning rates, and it's all about buying cheap and selling expensive. We will see how we can improve our risk-reward ratio. We were talking about how to pick up the best trades. I call it cherry picking. And we'll get some accuracy and increasing our winning ratio. And so let's begin. But before, meet me. My name is Gil Ben-Hur. I'm a pro trader in the past 14 years. I'm living in Israel. I'm having a wonderful wife and 3 kids. And I used to be independent trader for many years. I used to give services as a private portfolio manager. I was also a partner and a master trader in a trading community that had a premium trading education program at one time. I resigned once I wanted to create a funded a fund that lets community of traders join trade together. And we evolved since then. And today I'm running the fund that was the founder of, and I'm running it. The name is The5ers.com. And what we're doing, we're funding Forex traders, and we give them a lot of horizon to build their trading career with a very lucrative growth program. So let's begin about supply and demand order flow, because seeing my picture is really embarrassing. Okay, so supply and demand or order flow is all about the demand of the market and the supply that are on the shelves. There is no difference between physical commodities like bread, pharmacy, shoes, whatever, fruits, whatever. There's no difference between stocks, futures, any financial asset, Forex, pairs, whatever you name it that has enough liquidity. It's all being driven by the demand and the supply that is available. So what I want you to picture in your mind, and this is something I think many traders are forgetting, that the market represents a real activity that actually happening in the world. The supply and the demand that are in this earth in terms of currencies, let's say, is a real thing. It's not just a matrix of numbers that you can just put some algorithm on and analyze it with moving averages and RSI, all these indicators. These, for me, say nothing. What, for me, it's important is what are the incentive of these real people to come and buy right now, or for these people that are being caught with a lot of stocks and no clients whatsoever. What are the motivations in the market that will define whether price will go up and down? And when I look at charts, I'm looking for the narrative, for the story of these two forces, the forces of the people willing to buy and the forces of people that are willing to sell. I wouldn't say people, but it's participants, because they can be institutionals, they can be countries, they can be central banks, they can be hedge funds, and they can be a lot of speculated retail traders like most of us today. So all these forces, all these participants are joining together and creating a real market where there are forces balance of supply, the demanding and the demanding clients. So let's talk about the concept so we will better understand, and then we'll jump into charts, and I'll show you how these concepts are being seen on the charts. So first, once we understand that the market is a real thing, it's not just a matrix of numbers that can be decoded. It is a real story of what is happening in the world. And we have to understand that every time our platform is broadcasting for us a new tick into the market, a new price, or not a new price, but a new tick. It is a trade that was actually happened somewhere in the world. And a trade always has two sides. It has a buyer and a seller that both of them had agreed upon quantity and price. And price could be changed or unchanged. The quantity is the volume of what they've decided to do to buy and sell. But we really have to understand that every tick that comes into your platform is a real trade happen somewhere. Okay, so I know it sounds obvious, but most of us, when we look at charts, we just see numbers and we forget it's a real thing. This is why I emphasize this. And so when we have millions of participants coming into the arena of the market, whatever market it is, futures, stocks, Forex, whatever it is, it created some kind of balance between the people who are willing to buy and the people who are having the assets to sell. And there's not going to be any deal if someone wants to buy something that is not available, or if someone wants to sell something to buyers that are not in there to buy, right? Because we must have the two sides agreeing upon quantity and price. So in terms of supply and demand terminology, what happened, and this is the core reason how price move in any market, with the tomato market or in the financial markets, it's everywhere. And you think about any market that you know and familiar with, it works everywhere. When you have enough people buying enough supply, price will not change. Nobody has any advantage upon the other. So price is in balance and being unchanged. But we all know, and this is also pretty obvious, that when there are more demand for the price, let's say, like take these bananas example, if there are more people willing to buy a limited amount of bananas, they will fight for who can buy this product. So price will eventually rise to filter out the buyers that cannot afford buying at higher price. So at this situation, the supply is getting much more expensive because there are more people, more participants competing for getting a limited supply. So the simple rule is if demand exceeds supply, then price goes up, right? And the very same, but the opposite, is when there is much more supply on the shelves and the sellers need to get rid of the supply, the products that they're having, and there are less people willing to buy, they would give discounts, they would do anything to get rid of their product before they get spoiled. So price will go down. This very core mechanism that is very logic and very reasoned is how the market exchange actually work. The exchange, let's take the NASDAQ, when they have a pile of orders for people willing to buy a stock, and they have another pile of orders of people willing to sell the same stock, they will match these orders until one of the piles will be out. And when they leave And when the one of the piles is empty, there are other unfilled orders of people willing to take the other side that was left, right? So the exchange will now change the price in order to meet how people can actually fill their order at different price. Okay, so like we have seen, if supply exceeds demand, then the exchange will take the price lower. If it's the other way around, where there's more demand exceeding supply, price will go up. So this is how the exchange works. And this is why I think order flow is really the most effective concept of reading the market, because it's about the core of how price moves. It is the real definition for why price is moving up or down. So like I explained before, we have these at the exchange central, they are receiving for every price level, they're receiving two piles of orders, one for buyers and one for sellers. And now here you can see that the sellers having, at this example, are having less orders. So the exchange will match this order. They'll take this file and they match it with this guy, and it will create a deal. And then this one with this one, and they create a deal. And then eventually the sales order in this example will be empty, and all these orders will be leftovers. So price will now go lower, so more participants that are willing to buy the product, to buy the asset, can join in, because there are no willing sellers at this price anymore. So price will go down. But these orders that were unfilled, they are waiting there. They are waiting there in a few manners. One, they are waiting there in a psychological price, meaning the memory of the market is out there, knowing that this was a price that had a conviction for price to go down. And so these orders are waiting there. And there's also these buyers that actually had their orders in and they are not canceling them. So these orders are waiting there. This is our assumption in the market. And so I can show you how it's being read in the market on the charts. Okay, so when we're looking at a bear chart or a naked chart, what I'm trying to see, what I'm trying to find is what is the story or the narrative between the two forces, the buyers and the sellers. And now we can see here a chart that is actually ranging on the long term. However, we can take, with the understanding of supply and demand, we can use our knowledge in order to buy all these zigzag, buy and sell all these zigzags, and we can actually understand or behind the scene what's going on. And so what we're trying to look for when we're looking at the chart is to see where was a decision, a collective decision in the market to change direction of price. We can see that here on top, there was a decision for price to go down. Okay, we're looking, it's very easy and visual to see that turn around and also the impulse and the strength of the moving down. So we can see that around this area, there was a decision to change price. It's very easy, it's very simple, and it's very powerful. I'll show you when. Okay, we can see here price had decided to change direction and reverse upward. Okay, we can see that. We can see here again price is retracing, and from here it changes back. We see this big pole or flag that is rising up. This is what we're looking for. I just want to emphasize something about supply demand analysis. We are always analyze historical prices in order to take future trades. Okay, so it's not really coherent to new people that are not familiar with this material. So in this example, I'm going to show you how we can understand these areas and see what happened after this happened as if it's real time. So we need to have the history on the chart laid out so we can show you the reaction of the supply and demand areas on chart. But then we can also plan our trade ahead and take better probability trades with the same knowledge. So we need the history for this, okay? So here again, price is rising up and then we see the pole, the strong pole going down. So we have a conviction, we have a decision point for price to go down. And again, price is climbing up the pole and so on and so on. Every time we see a big pole, a big breakout, we can call it a decision. Okay, and these decisions are what we are looking for. And for every decision that we were marking, the next step is to find a specific price where we can sit on the chart to define that level as the decision level, as the break point. So we can see that after prices made the highest point available, it went down. It went another slight move up, and then price broke down, and from here it's just avalanche going south. So from here, we can assume if you try to picture again that pile of orders, the two piles of orders, you would see that many people would filing orders to buy, and to buy, okay? And here, there are more buyers, and here was the last buyer and seller deal. Here, we found the luckiest seller and the worst buyer in that situation. He was buying here and he is losing hell, okay? And here we see the last buyer before price as strongly went down south, okay? If we look, imagine the pile of orders laying out there, we can assume that we had a big pile of sellers in here and less buyers in it. So the the force balance that we see here is that there are more sellers that had no execution for their order waiting here. Why? Because there are more sellers, because all the buyers were gone. And because all the buyers were gone, the exchange took price down to find more buyers. So there are more sellers here. There are no buyers here, right? It's just pure logic, right? So because we have this very accurate place, this would be the price where we would want to sell next time price is visiting. Okay, so this is how we draw the supply zone. The upper barrier would be the risk zone that we call it, and the whole box here is called the supply zone. So price can go all the way up all over here before it will react down. It doesn't necessarily mean that price will reverse here next time, but it will definitely going to give us some reaction. Okay, so with high probability, we're going to have a reaction here because orders, unfilled orders are waiting here. Unfilled selling orders are waiting here because they could not get executed. There weren't enough buyers here. I hope that I made my point clear here. Okay, so we're creating this zone and we're stretching it all the way until the future. Okay, in this case, we have the future already plotted in so we can see what happened when price is climbing back to this very point that we were plotting. So many days after, few weeks after, price with its elephant memory was reaching in here, hitting the line that we were drawing on June 7th, and in August 15th, it went there and reacted pretty nicely. Just bear in mind, it's H4 chart. It has some good chunk of points to take from it. It's a nice reaction. It's not a reversal. So, but we still have a nice chunk to take off this event. Next time, price is going trying to make this level again. Now it penetrates even higher, but still the whole zone is still working. It's still creating a reaction with enough points to take. And for the third time, it had a very strong impulsive spiking of that zone. So that zone had given at least 3 occasions of good selling trade of it. Okay, the whole zone is reacting. So if we plan our trade, we would put our sell order here, our stop loss above, and we are good to go and try to make as much points from that bounce of the zone. Now, the same method, the same concept works on the demand side, on the buying side. Okay, we see that strong impulse, the strong pull. We are looking for where price was actually breaking the action here, and this is the line. And then when price is visiting next time that zone, it bounces up. And while it bounces up, it creates another zone of itself, which is another demand on top of it. And when price is coming back, it reacts, and now it creates a bigger move. So we can see that price is going between this demand to this supply. Okay, and price pretty much accurately is responding and reacting, at least at the first visit. So this would be the highest probability trade for you, is if you consider, we call it in the supply demand terminology, we call it untouched zone, or fresh demand or fresh supply. Fresh supply or fresh demand is a demand that was created and not yet being tested. So at this point, this supply was not yet tested and it's reacted once, twice, 3 times. This demand was tested already, so it's not a very high probability trade, but it still reacted. It's still wired with buying orders and with less sellers. Okay, and then for the third time again, and from now it is free to go much higher. Okay, we have more intrazones that are created, and that we can take lower time frame trades if we like to scalp, and if we like to drill down from H4 to intraday charts like M15, M5, then you can see that once price turn at any time frame, it creates a supply that is untouched. Then once price is going and hit it the first time, it creates a reaction. Again, I mentioned these are reactions, not reversals. We can never know or predict in high probability if we're going to see a true reversal. It's very hard to predict, but every real reversal begins with a reaction. So we need to take this. We need to take these opportunities, and it can turn out to be a good running a swing, but we also need to be aware that it can be just a reaction. So we should expect our risk management to be protected from when it's not taking the real course that we're expecting. Okay, so one thing to show, once price has touched a fresh zone, which is right here, we cannot consider this supply zone as wired anymore. Okay, although on the second touch, it still had a reaction, even slightly better one than the first one, it's still, for the higher probability, it's not a good idea to take it unless you have a very tight risk management that you would wish to consider. Yeah, Mark is asking about a triple top. So we're not looking at triple tops because, like I'm saying right here, once price was touching a fresh supply or a fresh demand, we cannot consider this zone as wired with leftover orders. We don't know. Our work is only assumption, and we're using our best assessment to to try to assess if that level is wired. The best thing for us to know is that if it's a fresh supply or demand, it has higher probability to work. Yet, every time in every single zone, even if it's fresh, we have to apply risk management upon it, because we always, at least this is my attitude for the market, I'm always telling myself, I don't know, I can't predict, I can only play risk management. So, but in terms of risk management, after first touch, the second touch is considered high risk. So I need to apply more knowledge and more experience into taking this. And proof to that is that on the third touch, it was just cutting through very easily all the way up. And look what happened when it just cut through very easily all the way that zone. When price was returning, you see that little pullback. You would see it better on intraday charts. But this is a reversal. It reversed all the way up on top of the zone. This is what we call a swap zone, where supply suddenly turned to be a demand. It means that it was broken, there are no sellers here, and on top of that, there was a conviction, there was a decision for price to go up. This changes the whole zone from being a supply zone that has more sellers into a zone that has more buyers, because we see the market is showing us that this zone is now being tuned with more buyers that drive price up. So next time, if we stretch this, we can see that in the future, when price was coming back first time to that new demand zone, it reacted up. So this is more advanced, but I hope you can see the logic and how simple it is to just read a story of buyers and sellers from a chart. And if you take this concept just by applying pure logic like this with straight rectangles, no other tools, you would see how powerful it is. I invite you to do so. Okay, so I was telling you that trading supply and demand, or the order flow analysis of a chart, is very rewarding. It will actually give you many benefits. I will sum it up in a few moments. But the best thing I like about this is that in terms of supply and demand, you would always attempt to buy when it's cheap, and you attempt to sell when it's expensive. Exactly like the logic of being a good trader at anything. I mean, you can be a good retail shoe salesman. You would want to buy your stocks very cheap and sell it to your clients expensive, so you can have the markup for your income, right? This is what we're trying to do. Very strangely, many traders, and we see it in our fund as well, many traders, they are trying to jump on the train. Only after the market is showing a direction, they join that direction. So the thing is that they are being caught up with a lot of drawdown when price is turning, because you see price is always making a slight progress and is breaking a level here, and now it's returning back. So this is why so many people are losing, because they are trying to trade breakouts. So trade breakout is just not making sense in the real world, but for some people on the financial market, it makes sense to buy when it's very expensive. So that's for me, it's a big no-no. And what's beautiful in supply and demand is that it's all about buying when is cheap, and it's all about selling when it is expensive. So we can take advantage of this. And while we buying the dips and selling the peaks, we are fortunate to have great risk reward ratio. So how we plan the trade? First, if we have this demand zone, we will buy at the very inner edge of the demand zone, and our stop will be just below the end of the zone where it has the lowest point that is created by the zone. Okay, so we have the buy at the inner edge and the stop loss just beyond the outer edge of the zone. In this one, in this trade, the reward, which is just from trading at the first time it went there, the highest reward, I'm not saying that we had any opportunity to take it. Maybe we did if we would consider this supply, but the actual reward that we had in this trade was here. So let's see, in terms of risk reward, what was the reaction value. I'm not saying that we have the knowledge to take this specific point, but just to see the potential, okay? So we had one risk unit, and we have at least 3 to 1 from our risk, because we were buying at low low cheap price. Okay, so we had 3 to 1, which is fairly good ratio when you're a beginner. But when you dive into supply and demand order flow, you can have much better than that. I can promise you that. If we take the other entry, the third touch of that demand, we would already get 5 to 1. Okay, so I'm talking theoretically. I'm not saying that it is possible to see all the opportunities. There are a lot of psychology and there's a lot of individual things involved here, but just to see how the market is reacting to these dips. Okay, if we sell here, and this is the definition of our zone, so we're going to sell at the inner edge of the supply zone. We will put our stop just beyond the outer edge, and then our reward would be, if that's the risk unit, we'll have about 3 to 1 risk reward ratio. Opa. 1 second. Just blew it. Sorry, guys. Going back. Okay. So we're about the end of our presentation, and I want to recap for you why is it so happy and feeling fortunate to be an order flow supply and demand trader. First is because it gives me all the explanations and all the reasoning for why price is turning. And I can promise you that if you go and do some research on this very specific subject, and you master this much deeper and you apply more price action knowledge in it, you would be able to play the market in such a great precision, and you could explain every slight move from 1 minute chart to weekly and monthly charts. Everything is being explained. Nothing will be just arbitrary noise for you anymore. I'm telling you, I used to, when I was finally, when order flow for me had clicked, I was playing 1 minute chart and it wasn't fast enough for me. It's just, you just see it bright like a daylight. All the swings of the intraday, the micro intraday, you can trade it and just have lots of fun with M1 charts, even if you want. Nothing will be unexplained anymore. You would always have a reason for it. And because this is the core reason for why price change, it is timeless. It's a timeless logic. It means that no big participant can take advantage of the mechanism that changes price, because price move only when there are enough demand and enough supply in the market. The balance or the imbalance will convict if price go up or down. So you can see that and understand that, and so you don't need to apply any algorithm indicators to help you out understand where are your odds in the market. It's a timeless logic that will always work. Even if the whole market is just robots, the price will be determined by the balance of forces between the buying orders and the selling orders. And us as humans, we can always find these areas where you see where the demand or the supply was created. And while you are going to learn deeper in this, you will be able to find also places where there is no demand, or places where there is no supply. And then you can play where you see a good seller's forces versus no buyer's forces, and vice versa. So these will give you plenty of odds to plan ahead your trades. So, and one more thing about order flow that I like is that you can apply it to any trading style. When I'm saying trading style, I'm not saying trading strategy, I'm saying style. Style means that you can be intraday, you can be swinger, you can be a hybrid of anything. You can combine it with any other strategy and knowledge that you already have. You can, it really depends on your style and your personality and your mentality strengths that you can apply this. So that's another thing. And so you can find the logic in any time frame, like I said before. And the best thing that I think is that the supply and demand order flow is really giving you the trade definition ahead of time. You know where you enter, you know where you stop, you know where your take profit is ahead of time, and you can play it set and forget, or you can just wait and snipe for the market to get there, but you're waiting for the market to come to you, not the other way around. So it's a really good way. And the best thing about order flow, that is a very simple and logic methodology. And I invite every and each one of you to just search. The internet is full with free information and very valuable information about this. And you can also write me, and I can send you lists of resources where you can understand and learn better this specific material. So before we go, I'd like to pay some rent for my team in the office. So I just want to say a few things about what we are in the 5ers. And so this is the commercial side of it. So we are funding traders. We have this program where we invite any confident and experienced Forex traders to come and try to join our fund as a trader contractor. This means that we accept all traders from all the world, including American traders that are limited with the brokers that they can choose. Trading with us is unlike trading with a broker. It's trading as a profession for a fund. The program is pretty much simple, and you can read about it in our website. We're very transparent. The whole terms and conditions is laid out. The whole program is very simple. Basically, how it goes, we test traders with 4% drawdown maximum, and we want to see 6% gain within 20 trading days up to 6 months. And if you make it, then you get fully funded and trading at no risk whatsoever. The whole evaluation process is being done on a real trading account. So whatever profits you make while you're being tested are being shared with you. And this is a big plus. So you're not wasting your time while you're trading real trading account, and you still have the opportunity to be funded with the 5ers. And the best thing, I think, in our program is that we are laid out a future horizon for any consistent trader that worked with us. As much as you continue to profit, we give you more and more capital. The program is built on a 10% milestone, and every time you meet the 10% milestone, we actually double the account. So you can start with $10,000 account, and we double the accounts up to $1.28 million guaranteed. Beyond that, it's upon private negotiation. So I paid my commission, and I would like to thank you all for joining me with this presentation. I really encourage you to go and dive deep into order flow, supply and demand. Search this, write to me, and I can send you more free resources where you can get some quality education for free about this thing, because I really think that trading should not be a secret, and also we encourage knowledge and knowledgeable traders to come to us in the future when you're ready. Anyway, thank you so much for attending. Thank you, David. Yeah, so have a great